when we talk taxes, there's a certain amount in taxes that we're gonna, it's like there's a certain amount we have to pay, and I have no problem with paying what we owe. That's appropriate.
Welcome to the Semmax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement.
Hello and welcome. My name is Matt Landon. I'm the CEO of Semmax Financial Group, and I just so happen to be a CFP. And I'm joined here by Jordan Shinsky, one of the financial advisors who is also a CFP.
That's me.
Thanks for coming.
Sure.
All right.
Should be.
So the topic that we're going over today is tax strategies.
Right.
And there's some that I think are a little bit more common. We'll touch on some of those, but there are a few that are a little more esoteric or unusual, and maybe we'll dive into some of those as well. But right off top of the dome, what's your favorite tax strategy that you love to employ?
Ooh.
I know I'm hitting you with
That's a good question, but here's the deal. The one that meets the client's goals most appropriately.
Okay. But is there, I like that.
Yeah.
But is there one that you find more people than not would find more value out of? Because I know where I'm thinking of, but I don't know what your opinion is.
One of the most common ones that we end up running into is the use of Roth conversions.
Right.
Okay. That's one that we see a lot of. And that's the idea behind that is ideally when we're talking about tax, it's, are you trying to minimize your tax consequence now in your present years, or are you looking to defer or eliminate tax consequence in your future years, right?
So kind of saying this year, what are we doing for April versus what am I doing for 10 years down the road, 20 years down the road, my kids, that kind of side.
Right.
Okay.
When we have a time to take advantage of something like that, Roth conversions do a great job of that because they're taking that pre-tax money that you have not paid a penny in taxes on and realizing the tax consequence in the year that the conversion is made, positioning it now in another tax deferred growth program where when it's eventually used in retirement, that money becomes tax free to the user. In opposition to that, if I'm maintaining my pre-tax or tax deferred program in a traditional IRA, traditional 401k kind of situation, that money, I'm realizing the tax efficiency on it today and in my working years. Then I'll cross that bridge when I come to it, that I have tax consequences 10, 20 years down the road.
Well, and I think that's an interesting point because, well, two things I would say. One, what do you think about cross that bridge when it comes to it? If you're a year away from retirement, you're in your highest income producing years, and you're saying, wait a minute, next year, my tax bill is going to be significantly lower. You may be better off putting that money in pre-tax, correct, and doing a Roth conversion in a year. Than you are doing it now. So I think it's some of it comes down to timing.
Well, timing's a big thing as well, because a lot of times when people do enter retirement, they're not necessarily reaching that point immediately where all of a sudden now distributions become necessary.
Right.
So there's a window of time where, let's say my debt picture looks good. I have multiple passive or reliable income sources that are satisfying my cash flow needs. I don't need to take distributions for my qualified money. I can use that opportunity for, in some cases, 8, 10 years in the future before that demand hits me for taking what they call required minimum disbursements. So there are opportunities there that allow you to reposition that money in time.
You can flex it a little bit.
Sure.
One other thing I would say is, and this is something that's no time bound, but we got a triple meal, big, beautiful bill. Right. So this is something that came out. And so you have a situation where you've got certain tax advantages for folks over the age of 65. Right. But some of these tax cuts go away in several years. Some of them have been made permanent. And I would put a caveat here and say it's only permanent until Washington decides to change it again.
That's
right.
That's the truth.
But I think that's something that is really key on the Roth conversion side, because there are folks who we may have done a larger Roth conversion because we were looking at tax brackets. We were also looking at what is your Medicare premium going to be impacted by, right? But now we also have to consider, well, if our income goes up too high, we lose an additional deduction.
Yes, right.
So I think it's really key when you're looking at this that now you look at it with fresh eyes in the light of the current tax system.
Well, that's also why when you're sitting down with your CPA, or I'm sorry, with your CFP professional, or in some cases your CPA, should also be in conjunction with it. You're looking at this yearly mean out, right? Because oftentimes our cash flows, our financial demand, and even our income sources are going to change from year to year. So you have to take that into consideration.
Well, let's talk about some things that maybe can be an advantage that are outside of just the Roth conversion side. Sure. One of the ones that I know we were talking about earlier today that I find really exciting are certain non-correlated funds. So there are investment strategies that are not the typical stocks and bonds. We're seeing that become a little bit more prevalent because we're seeing a lot of folks chasing a few dollars.
Mm-hmm.
Now, this I would say would be more applicable for non-qualified funds, not IRA money, but those after-tax dollars, right? That you have tax consequences on. But things like oil and natural gas investments, there's ways where you can get a reduction in that gain. There's also ways where you can distribute it out. And so I think it's important when we're talking about tax strategies, some of them are the big picture moving money types, which I would argue a Roth conversion is moving a money type. Yeah, it's taking it from one column, moving it into a different column. But you also want to consider inside of that column how we have that money invested. Mm-hmm. Now, don't laugh, but I sat down with someone and they had an IRA account. All of their money was pre-tax. It was all IRA money. And they had been told it is tax advantage to use municipal bonds because municipal bonds are a tax favored product. Which is true. I saw you shaking your head and you're like, no. Well, it is true because they are a tax-favored product. The issue is the tax advantages are when you realize those capital gains, when those dividends are coming in. And with an IRA account, you're not being taxed until the money comes out.
And so when the way it's taxed as well,
correct,
it makes the advantage of a municipal bond irrelevant.
Correct. Because it stays inside that IRA account. And the other trade-off is municipal bonds tend to have lower rates of return because when you factor in the tax advantage, that's how it comes up to your benefit. So that would be an example of where a little bit of knowledge can actually be a dangerous thing because they're thinking, I'm trying to be more tax advantage. I heard someone talking about municipal bonds. This seems like a positive. Let's do that. Yep. And yet inadvertently, it was no tax advantage. And it was reducing their effective return. Right. So what are some other strategies that you like when we talk about taxes and tax considerations?
So around those, right? Understanding that with every investment strategy, with every financial money move that may take place within the portfolio,
right,
there are going to be positives and negatives that could occur, right? Yeah. The biggest thing is that what is the appropriateness to your goals with your money? And I'll use this as an example. And the next one that I want to discuss is you're familiar with what a donor advised fund is.
Yes.
Right? Okay. So for clients that are unfamiliar with the donor advised fund, it's the idea of donating to, if you're donating to charities, if you're tithing to your church, the opportunity to transfer assets or to get money in that fashion is tax advantage, right?
So let's make it really simple. You're taking money and you're saying, I'm allocating this money to charity. You put it in this donor advised fund. You have not turned loose that control yet. Mm-hmm. So you can future gift instead of giving $20,000 a year, you can put $60,000 in, get the full tax advantage,
right,
and then do the standard deduction over the next 3 years and gift that $20,000 out from the donor advised fund. So you're maximizing your charitable gift.
Right.
Okay.
Right.
So with that in mind, what's the issue?
What you don't get to charity. And there's a right to that point. A lot of times what we do with that type of program is, let's say we have highly appreciated assets. I bought Apple stock at $5,000 and now it's worth $50,000, right?
Well, then you're going to have a massive capital gain issue.
I'm going to have a massive capital gain issue if I sell the stock and I give that money to the church. But if I take that stock and then position it into a donor advised fund, I allow the fund to distribute that money out over a sequential period of time. I was giving that money anyway. What I've now done with that is I've passed on the tax consequences away from my own personal filing and don't have that issue now because the donor advised fund is gifting it to the 501c3.
So let's say let's say you're in a 20% effective tax rate.
Mm-hmm.
So you just saved yourself 20% in taxes from that deduction.
Mm-hmm.
And then on top of that 15% capital gain you would have had to pay, you just saved that as well. So effectively, you just saved 35% in taxes, right, on something you were doing. I think a donor advised fund is a beautiful way to deal with that.
But I'm alluding to this, and I've already said, What happens if I don't get to charity? What happens if I don't give to a church? Right. So while it sounds like a great strategy, and I may fit the mold, my assets and everything look like a good opportunity to take advantage of it. Is that part of my goal? Is that what I intend for my money to do? So maybe there's an alternative to it.
So what you're saying is each one of these strategies has to be tied in with the individual.
Very user specific. It really is.
It's the same thing, I think, with net unrealized appreciation for AUAs.
That's a big one.
So I really, really like seeing when folks have company stock from their employer that's publicly traded inside of their 401k, right? Because one of the first things I ask them is, what is your cost basis? And you know where I'm headed with. Oh, yeah. The reason being, for those of you that don't know, if you hold company stock inside of your 401k, when you roll it out, instead of rolling it to an IRA, you have the ability to roll it out to a non-qualified account or an after-tax account. Now, when we've always been told, when you take money out of your 401k, when you take money out of your IRA, you have to pay income tax.
Right.
This is still the case. However, you do not have to pay income taxes on the balance that you're transferring out. You pay income taxes on the cost basis, which you originally paid for. It's called an NUA, or a net unrealized appreciation, right? So what happens is, when we take that money out, let's say your cost basis is $35,000. Let's say you're in a 20% tax bracket. Well, we're only paying 20% on 35, not the 100,000 that's worth it. Then when it goes into that after-tax account, you have the ability to liquidate it there, and you would only pay on the capital gains at your effective capital gains rate, which, as we all know, is either going to be 0, 15, could be 20. You might have alternative minimums, but generally speaking, your capital gain rate is always going to be lower, right, than your income tax rate. But that's the kind of thing where I say, okay, layering an MUA in with the donor advised fund you just mentioned, because maybe you work for Apple, maybe you work for Microsoft, maybe you work for Old Dominion.
Yeah.
You know, these are companies that are publicly traded companies. You may have bought that stock a number of years ago. It's done well. And before you just roll it all out to an IRA, you really want to think through, what are we trying to accomplish?
If I spend 40 years with the company and I've been receiving stock, in my plan all 40 years, you may have, in some cases, 35,000 to 100,000. Some cases you're talking 50,000 cost basis to 800, some million to $1.5 million in stock value. It's significant, right? You don't take advantage of that. Is a timing thing. You got to talk to your advisor, and you got to talk to your CPA about whether this works. And there are stipulations. It can only be done one time. It has to be done right when it's moved out. If you take and say, well, 3 years ago I retired, I took my 401k and all my stocks and I rolled it into an IRA. Guess what? It's too late. It's too late. I can't do it. So you got to make sure you have that conversation to see what's available.
Absolutely. Now, here's another one that I think is kind of an interesting from a tax strategy perspective. I really, again, circling back around to the big, beautiful bill, you want to make sure that the strategies that you're employing, if you're listening to something that came out 4 years ago, it may still be applicable. It may not.
Oh, yeah.
Right?
Yeah.
And so some of these things are going to be situational and dependent. I know a lot of folks that have opened up a small landscaping business, bought themselves a new pickup truck. Well, the rules of the big, beautiful bill say that pickup truck, if you're trying to depreciate it, it needs to be 100% utilized for business, not personal. You can't have kind of this 70-30 split or anything along the line.
Mixed use.
Yeah. That mixed use, it's really changed. So there's some advantages that have kind of gone away a little bit or have been modified.
Yep.
But what about real estate? Because I love the idea of you buy a rental property, you depreciate it for a number of years, and you do that while you're in your high income producing years. Then when you're retired, maybe you say, I'm retiring not just from work, but also from being a landlord.
Yeah.
So on the front end, talk to me a little bit about real estate and how we can use it from a depreciation perspective.
Yep.
And then we'll get into, well, how do you depreciate it, but now I have this cost basis issue, and we'll address that.
Yeah. Well, that's exactly right. If I'm using real estate as an investment vessel generating passive income, I'm using it as rental properties. It's not personal use.
Right.
I have the ability to depreciate that over a period of time, right?
Okay.
Running off basically the expectation that wear on the home and stuff like that, things that you should bring that value down. Okay, allows me to take advantage of that. When we get into a point where, and you alluded to this, there are several options that oftentimes that's one of the basic things we run into with people with rental properties. I've been doing this for 20 years. I've made good money off of this. It's consuming my time, right? Maybe I want to liquidate these properties. I'm going to go ahead and sell them off. Well, I depreciate value of them quite significantly. I mean, look at what real estate has done in the last 10, 20, 30 years. Right? If I done real estate for 30 years, I'm going to buy a home for $80,000. It's worth $500,000. What's that going to do when I sell it? It's going to create a significant capital gain for me. And maybe I got 10 of those properties or 20 of those properties, right? Now, there has to be a very clean strategy that takes place. There are some options available for people. When we're looking to transition out of ownership, we may be able to, let's say, start with consolidating assets down. I can use a 1031 exchange, right, to sell a right-hand property into a new property, right, passing that tax consequence on into the new property. But if I'm looking to get out of it altogether, at the end of the day, I'm going to face that tax consequence or necessarily not. We can use something they refer to as a DST or statutory trust. That's correct, right? It's repositioning the ownership of that property into a trust that now takes and invests into a real estate investment trust.
So I know that you can invest it in the DST. You can go into specific properties that allow you to have that tax advantage. Now, at that point, it's going to kick off a K1 for 7 years.
Right.
Those of you that own real estate, that's not going to be anything new, something familiar.
Right.
Now, if you use an accelerated DST, you can do it in as little as 2 years. Then you can transfer out of that DST into a liquid REIT. And at that point, you're able to realize a 1099, which is a much more favorable from the perspective of you don't have to wait on those K1s until March or June or April or September. It's like you've got that 1099 coming out much earlier. The other nice thing about that is if you go with a liquid REIT, and I would say be very cautious about which REIT you utilize, because some of them, are you actually getting a distribution of gains, or are you giving you partly a distribution and partly return of premium?
Yeah.
Exactly right. So when you look at that, when you have that liquid REIT, if you have the ability, and this is where I would say you want to set that up perfectly, to where you can do partial distributions out of there. And so you're kind of shaving off a piece of that tax consequence over time. Instead of when you sell that property, it all hits at once.
Oh, yeah.
Right? If you're able to realize it over 2 or 3 or 4 years, it can keep you in a lower tax bracket. Right. And it affords you the advantage of keeping more of what you've put.
Well, and also one thing that people run into when they transfer assets like that, if you liquidate property, is that it changes your cash flow.
Correct.
I've been receiving rent off these properties for the last 20, 30 years, right? Now, all of a sudden, that rent's gone. What does the DST do? Well, it continues to pay me an income source that helps satisfy that replacement of funds.
Yeah.
So it helps alleviate that kind of abrupt turn in what I've been receiving as far as income is concerned.
Well, and I would say to that point, when you think about what are these dollars doing, what are we trying to accomplish from them, mm-hmm. right? There's a big difference between the funds that I need for income and cash flow versus the funds that I'm using for accumulation, maybe for a later distribution, versus legacy planning and growth planning and kind of that generational wealth.
That's another aspect to this as well. In fact, I just had this conversation a couple of weeks ago with a client talking about DSTs, talking about the opportunity. Rental income has about 5 properties, right? Need to look and get out of it. So we talked about the idea of utilizing DST. He was familiar with what it was. We also talked about the idea of, well, if you don't want to get rid of these properties, what are the solutions, right? And his idea, he still wants to give it to his kids. His primary objective is still to pass on those properties to his children. So the DST takes that opportunity off the table.
Right, because that's predicated upon the sale of those properties.
Correct.
Which is not, it does not sound like that's his ultimate objective.
No.
So did you talk about using a rental agency?
We did. We talked about using a management agency,
right,
taking his active role out of management of it, and a fee, of course, but it allows him to continue to receive at least the majority of the rent income and separate himself from the active management of things. Then, when he passes away, his legacy transfer, his estate process is passing those properties on to his children, who then receive it at a step up in cost basis, right? So we're talking about, again, kind of that tax mitigation, the responsible approach to it gives him favorability by maintaining ownership, just passing the responsibility off on a manager. And then passing his properties on when you had like that. What?
So you brought up something really key there, which is around the estate process.
Yeah.
Because if he said, I want to go ahead and turn over control of these properties, I'm just going to gift them to my children now. You're gifting the cost basis along.
At your cost basis. That's correct.
So I think that's where having your estate planning set up along with your tax planning, along with your financial planning, it's not three separate things. Well, they are three separate things, but you can think about them as three pillars all holding up the same home.
Yeah.
Right. It's like, this is all parts of you overall.
I think them as three quarters of a triangle, right? And they all play into the one big shape, but they all interact in a fashion that you can't have the triangle without any one component that we discussed.
So I'll give you an example of a client that I was meeting with. This was actually earlier today, funny enough. And they're in a situation where they're very charitable. They have a net worth. Their estate's going to be a little over $4 million today. And obviously the expectation is it's going to continue to grow.
Right.
Well, they put in their will that they wanted 10% of their estate to go to the church. These are folks that they're strong Christians. They believe very strongly in that. And they say, we want to tithe, and we want to tithe at the end as well. And I had a conversation with them around this because they have a sizable amount of IRA funds.
Okay.
But that $400,000 is going to come from the will. That's going to come from the estate, which as they step up in cost.
Yeah.
And so we discussed, if they leave $400,000 out of their IRA to the church is going to get the $400,000.
Right.
If you leave $400,000 out of your will, the church is going to get the $400,000
thing. Yeah.
But if you leave that $400,000 to your child, they have to pay federal taxes. They have to pay state taxes. They may only walk away with 75% of it.
Yeah.
You know, they may give $100,000 to the IRS and to the state. Whereas if they had received it out of the will, they would have kept that whole 400.
Right.
So that's a situation where your estate planning and whether you're charitably inclined or not, to your point, whether you gift that rental property now or later, you know, or whether you're gifting to charity now or later, which bucket you're pulling from has a huge impact on ultimately what your family is going to receive, what kind of legacy you're going to provide.
The strategy could create additional tax efficiencies to your big picture that, in all fairness, most people, they're not thinking through that themselves. It is great that they're giving 10% of their estate, of their big picture, to the church. But as you've mentioned, is there a right way? And I won't say a right way and a wrong way, but a way to do it, and potentially a better way to do it. Yeah.
I would argue that when you are talking with an attorney, they're going over things from a legal perspective. Yeah. And when you ask them tax questions, they go, that's not my purview. Right. Then when you talk to a CPA, they talk about things from a tax perspective. And you say, okay, what's going on in legal? That's not my purview. Right. When you talk to a CFP, we're kind of sitting there in the middle and we're talking about tax plan. We're talking about estate plan. Now the nuance, I'm going to pull a CPA in. I'm going to pull an attorney, but you want that overarching theme. Last thing I'm going to say before we close is if you're over 70 and a half, there's QCDs that are available to you. If you're under 70 and a half, there's the donor advised funds. We have touched on a few different things, but I would just say this, regardless of what your plan is, to your point, it's got to be tailor-made to you. And the strategies that your coworker might come into the office talking about may not apply to you. And when we think about taxes as a whole, we didn't even get into things like utilizing an HSA while you're working and some of the nuance around that. There's a lot of different things you can employ. I would say the key thing is to not just get information, but start getting confirmation on the right decisions and how does this apply to your plan, and keep it ongoing. So do you have any closing thoughts you want to close us out with?
It is important that you consult with a CFP professional. In today's day and age, I would have to say that the increasing complexities around people's financial profiles, nowadays, there are more strategic opportunities to take advantage of than ever before. But you don't know what you don't know. Meeting with someone that has the experience, that works with people day in and day out, that take advantage of these strategies, is something you need to be able to sit down, talk through, and find out what strategies are or are not going to work for your particular situation.
I would agree entirely. And I would close by saying this. When we talk taxes, there's a certain amount in taxes that we're going to Yeah. And I was like, there's a certain amount we have to pay. And I have no problem with paying what we owe. That's appropriate. What I take issue with is when we pay unnecessary taxes because we're not taking advantage of the things that are available and are there for us. So thank you so much for joining me for the conversation. I always enjoy it. I always enjoy chatting with you. So thank you for watching. I hope you learned something new. And if you have questions, you're welcome to reach out to us.
Thanks for joining us for another episode of the Semmax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semmax Way should not be considered as investment advice. It is always recommended consult your licensed investment representative and a competent tax advisor respectively for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.